So when it comes to choosing a strike price and or an expiration date, if you talk to 10 different people, you'll likely get 10 different methods for how they go about doing that. And that's not to say that, anyone else's way is the wrong way. But in this video, I'm going to show you guys what my process is when I'm trying to decide what what contract I'm going to choose for an option that I'm considering. But before we get into that content, please like, share, subscribe, leave a comment if you feel moved to do so. But I appreciate you guys for watching. Make sure you go to chartsandpriceaction.com and check out my latest course offering with By the Hood. We did a part two to the installment last year. That was an intro class. But this class goes deeper into price action and practical psychology. And in that, I include a few of my rules from my trading Bible that have proven to be really helpful when navigating the market. So make sure you guys check that out. But let's go ahead and talk about my method for choosing a strike price and an expiration date when I'm considering an options position. So my process has very little to do with the cost of the contract, and a lot of people that's like priority number one, and I understand because you don't want to buy or attempt to buy something that you really can't afford, and then in addition to that, something that is above your risk tolerance. So that's definitely important, but for me, I don't let that drive my reasoning for choosing. A particular contract. So I let the price action tell me what is a reasonably good strike and expiration for that position or that stock. So I'm going to use UPS for as an example to show you guys or to illustrate how I would go about choosing a strike price for UPS. And for me, if I find, like I said, the premium is kind of not necessarily an afterthought, but it's really the bottom of my list of priorities when it comes to what options contract I'm gonna choose. And so if it's too expensive, of course I can't buy it. But if it's too expensive in the sense that it's above my risk tolerance, then either I don't take that position, maybe I paper trade it, or I move on to something else. You know what I'm saying? So uh, I'm not gonna necessarily uh, choose something that's too expensive and then I end up messing it up because of my own emotions. So that's something that's something to keep in mind. Is that a lot of times when we goof up on a position and then it turns out to be the right position, especially it's because you were over leveraged. So you put on too much risk. So if you find yourself very uncomfortable in any one options position, check to see how much risk you have on. Maybe you need to dial back that risk a little bit. So that's just a little tidbit to keep in mind. But let's go ahead and talk about what I would do for UPS. So for UPS specifically, what I've what I've noticed is that it had been trading in a range, right? So for me, I would not choose a strike outside of that range, right? Because the price action had been telling me that, yo, this anything outside of this range is gonna be low probability for you. So why even risk that? So as you can see, every time that UPS dropped down to this level, so 172 and below, it gets bought up. And so keep in mind this is a weekly chart. So for me, let's say that UPS was at 170, and maybe it's at the end of the week, maybe it's at the beginning of the week. So for me, in looking at the time that it usually takes UPS to go from the bottom of this range to the top of this range, it usually takes about 7 days or so a week or so. Sometimes it takes a little more than a week. So for me, if it were Monday, like it is Monday, and let's see, well, let's say that the price is right down here in the 172 area. I would be looking, if I want to play it safe, quote unquote, I would first be looking at a strike for Friday at around 170. I'm not even sure if they have increments less than five, but I would be looking at a strike of about 175. If they have a 177.5, I would be looking at that somewhere in there, maybe 180 tops. And then if I were looking to try to trade it up to the top of the range, I would likely push that strike out another week. So hopefully that makes sense. So for that next week, if I wanted to push my strike out beyond the 175, 177 area, then I would likely push my expiration date out another week. And then that would allow me some more wiggle room to push out my strike to beyond 180. So maybe I would go for 180, 185, maybe 182.5 in that instance, right? That's because that's what the price action is showing me. So let's look at UPS right now. So you see last week that UPS closed above the top of this range, so above 185, right? So let's say I was thinking of getting into a bullish position. And of course, this isn't investment advice, and I'm not saying that this is what's going to happen. I'm not saying that this is a position that I'm thinking about, but I'm just speaking in hypotheticals. So let's say I'm bullish on UPS this week, right? So for me, if I were looking for a Friday expiration, I probably wouldn't go beyond 190 on a strike. Maybe 192.5 if that's available. A matter of fact, let's see if that's an available strike for this one, for Friday, UPS. Yes, so 192.5. So I would not go beyond this 192.5 strike for UPS, period, regardless of what's going on. You want to make your trades as high probability as possible. So you call on whatever tools you have at your arsenal in order to confirm or deny whatever your hypothesis is. So, for instance, if I'm bullish on this, you can't just choose any strike and expect to make some money, right? You want to make it high probability. So, a 192.5 strike has a higher probability of success than a, let's say a 205 strike because simply, hey, it's cheaper. And I know there's a lot of people out there that go approach options trading with that mindset that, yo, this is cheaper, so let me grab this. It's bullish anyway, I should make some money. No, that's, while you may make some money, it's possible, but you want to make better use of your capital and time with a closer strike, or a more high probability strike. So let's say I wanted to push beyond this 192.5 strike or 190 strike for Friday, then I need to push my expiration date out another week. So in that case, maybe I could go to 200, maybe. But again, I'm gonna look for about that 197.5 since it's a further strike than a 195. But I'd be looking at either the 195 or the 197.5 for next Friday's expiration. And let's take a look at that one. So that would be August 5th, and you see the 195 is 390, and then the 197.5 is about 305 as far as the asking price is. So I probably wouldn't go beyond that, and I said maybe to 200. So those are three strikes that I would consider if I wanted to go further beyond this initial strike of 190 to 192.5 for this Friday. So hopefully that makes sense to you guys. Um, and hopefully it's simple. It's simple for me and it helps me tremendously in my options trading. And and you can use it for any time frame that you're considering. If you're, even if you're day trading, um, let me think of something that who had a big dip today? Maybe let's try this one. All right, so let's look at a 15-minute chart for this one. All right, so, well, yeah, let's do 15 minutes over 5 days or so. All right, so what you can see here on this 15-minute chart is that this one's been kind of trading in a range, right? And the range coming into today was roughly uh, 56 on up on down to about 50. So about a 6 point range, right? Coming into today's session. Um, so for me, if I were considering a day trade on this one, before the fact, first off, I'd want to duplicate this drawing. That's a tool in Thinkorswim, and simply let me fix this and just connect it to this one. Connect it right underneath the first box that I drew, and I would measure the about the mid range between or the middle point between these two ranges. And coming into today's session, I would say, okay, I'm bearish on this one. Let me choose probably a $48 put, right? Because you see, it's not one that has, 7, 8, 9 point moves on a regular basis in a day. So that's not necessarily something that you want to take a chance on and say, yo, I can only afford the $40 strike. So that's the one I'm gonna get. And maybe the $40 strike did have some nice movement because I mean it did have a nice breakdown here today. But again, you want to have the discipline or build the discipline to make your trades as high probability as possible. And everything that you do when it comes to trading and navigating the markets should be in support of your whatever your goal is. You know what I'm saying? In the most efficient ways possible. So for me, I probably would have chosen maybe like a $48 put for this one, or maybe even down to 45, maybe, but I would not go below that $45 strike. But today just so happened to be one of those days that the price just moved a whole lot more than what it typically does. It may have been a catalyst or something, I don't know, or maybe just sentiment with the rest of the markets, but that's just something to keep in mind. So you can do it for any time frame. And for this one, as you can see, it took 1, 2, 3, 4, 5 days for this stock to move down 6 points. So naturally, I would have chosen of course, Friday expiration. That's the only choice you had for, in the sense that it doesn't have the type of expirations that a QQQ or a SPY or SPX has. It has just those weeklies and monthly expirations, as far as I know. So a $48 put for Friday, maybe a $45 put for Friday at the most. So hopefully that helped. I didn't want to make this too long. If you guys have any other questions, feel free to let me know in the comment section. If this helped somebody, share it. Let me know. Let me know what you think about this content, and let me know what your process is for choosing your strikes and your expiration dates for your options contracts. I'd love to hear it, and I will talk to you guys later. Thanks for watching.